Hello and welcome to another episode of Get Your Fill, Financial Independence and Long Life, where we explore ways to achieve those two goals. And when we find a person who can really help us with the financial independence piece of all this, then we are very excited to have them. And that is why I'm really psyched that Jacob Vanderslice is with us today. He is a principal at VanWest Partners, which is a Denver-based real estate investment firm focusing on the acquisition and management of self-storage centers and other opportunistic real estate throughout the U.S. So we want to hear about that because self-storage is something that I think is real interesting and stuff. There's lots more information about Jacob, and his whole bio will be on in the show notes, along with how you're going to reach him when you find out how cool this is and how you want to be a part of it. But Jacob, so why self-storage? Because it seems to me it's not that romantic. How did you get started in it?
Well, Christine, first of all, thanks for having us on today. Great to meet you. I could not agree more that it's not that romantic. I certainly didn't go to high school dreaming of being a self-storage investor, owner, operator years down the road, but that's how it goes. I thought I'd be a fighter pilot, and now I just sit at a desk and talk about deals all day. So,
but luckily you have a propeller in your corner.
I do. So I did the next best thing. I got my pilot's license when I was in high school, and I fly airplanes for fun. But I'm not taking off the Air Force Base in an F-16, unfortunately. But another life.
Yeah, next time maybe.
So why self-storage? We've done a lot of asset classes over the years. We've done single-family residential, townhome development, retail, office, land deals, and we fell into self-storage in about 2015. And we had studied it for a while, and we liked the fact that it's historically recession resistant and kind of downturn protected. We like the scalability of the operational platform. We like the durable recurring revenue streams. And historically, when there's an economic disruption event, self-storage performs pretty well. So we like the downside protection. We like the reasonable and quantifiable upside. And more specifically, we like the granularity of the revenue streams. So we're relying on thousands of people to pay us, $30 to $300 a month.
Right.
And they're all month-to-month leases, so we can respond real time to supply and demand changes. We can raise rents on deals that are performing really well, that are really full. We can lower rents on unit types or deals that maybe aren't performing as well. So we think it's a pretty good, asset class in terms of a good risk-adjusted return. So we like it. We'll see how it goes.
And I wonder, I'm just, as you were talking about that, I was thinking that when the economy isn't as strong, I wonder if people are even more inclined to hang on to stuff that they might trash if they thought they were going to have an unlimited income stream.
Yeah, no, it kind of depends. I mean, when I mentioned disruption event earlier, friction in the economy is what drives self-storage demand. And by friction, I mean kind of people moving up and down the economic ladder, getting married, getting divorced, getting a new job, losing a job, relocating to a new place, downsizing from a house to an apartment. Really, life changes are what drive demand in storage. And when there's a downturn, there's a lot of life changes, for better or for worse. And the pandemic, a lot of people needed to clear out their third bedroom for the home office. Storage demand went up for that reason and many others. So it's defensible. We'll see how everything performs as we kind of go into this downturn, which I think we're already in.
Yeah.
Probably pretty safe to say that we're there.
Yeah.
But it's a good asset class.
Now, are you building units or are you buying ones that are existing?
So we're doing both. We have two vehicles in our self-storage investment platform. A few months ago, we launched our third storage fund, and Fund 3 is only buying existing facilities that are already there that we can add value to with capital improvements, but mainly management efficiencies. And then outside of Fund 3, we're doing ground up development projects within the context of single asset syndications. And for those of us listening who may not be clear on both, a syndication is typically one deal. A sponsor will go out and raise money for, make an LLC. And a fund is kind of similar, but a fund is a collection of assets. So we thought development was a little bit too different of a strategy to mix into a fund vehicle. So we're doing those outside of our fund. So we have a deal under development right now that we closed a few months ago on the Front Range north of Denver. We've got 3 other deals in the pipeline that are closing in Q1. So we build and we also buy existing as well.
Interesting. When you're scouting a location, are there things like similarities that are going to, in the demographic or in the area or anything density that make you know that this is probably going to be a pretty safe place to build, or this is going to be an area that should be successful for self-storage?
Yeah, as it relates to self-storage specifically, one of the first things we look at are supply ratios. Nationally, there's about 8 square feet of storage per capita. So historically, if a market's been well over 8 square feet per capita, it's been kind of oversupplied, and under it's undersupplied, and eight's kind of the median. That's not a kind of a universal metric that we live and die by. Some markets that might have 12 square feet per capita, which is a lot higher than the national average, all those facilities are full because the rents are so low. So what that means is if there's more supply and rents are low, more consumers can afford to store.
More crap.
So we also look at rents. Yeah. If it's cheaper, more people, right? If it's more expensive, fewer consumers can store.
Yeah.
We also look at rents in the market. That's a big driver. And we look at rents relative to the in-place rents on an existing deal that we're buying. So we like to see rents, below market compared to competitors. Maybe the owner is not good at revenue management. They're not good at bringing customers up to market rates. So really rents and supply ratios. And we also analyze the risk of new supply, and kind of subjectively or objectively, what are the chances that someone's going to build a facility nearby during our hold period. And we obviously can't completely protect against that, but if we're buying a deal well below replacement costs, we know that it's going to be tough for someone to build at an attractive cost basis for the rest. And beyond those different specific self-storage parameters, we look at just good real estate nuts and bolts. We want to see housing density. We want to see rooftops. We don't like buying in overly rural locations. And of course, we want to see population growth, job growth, good wages. So a lot of the standard real estate fundamentals apply to storage as much as they do to multifamily or single family.
Yeah. And I would think, I'm thinking about land prices when you're building a new type of structure. What makes self-storage a better investment or a better, financial return than building some sort of multifamily dwelling or apartment building or something like that?
Yeah, it kind of depends on how you look at it. A number of sites out there might have a zoning issue where multifamily is not allowed, but self-storage might be, and kind of vice versa. We typically, when we're looking at a new development site, we're looking for sites with multifamily construction either nearby or in the pipeline nearby. And we're looking for sites that are really tough to entitle. One of the benefits of storage as opposed to multifamily is it's much less operationally intensive. We're not dealing, I'm going to sound like a dirty capitalist here, but we're not dealing with fair housing laws. We're not dealing with repairs and maintenance on places that someone lives, just places where someone stores. And we're renting out steel boxes without kitchens or toilets. So inherently, the repairs and maintenance are much lower than multifamily, and the risk of default on a customer is to a degree lower because number one, they're paying a lot less whole dollar rent, and number two, you don't have to go through a full eviction if they decide to not pay their rent.
Right.
So operationally,
and you're all done.
a little bit simpler. Yeah. And especially in this environment, depending on the market that you're in, it's if a tenant rolls over on you on their rent, it could be a while before you get a replacement by the time you go through the court system. So that's kind of one of the advantages too. But multifamily is a great asset class too. I think affordable housing, not affordable housing, but attainable rental housing is going to be in strong demand indefinitely, just given that I think our country is continuing to shift from a nation of homeowners to a nation of renters. The home price appreciation that we've seen is obviously untenable, and now it's moderating. Interest rates spiking, it's tougher to buy than ever. So people are going to rent apartments, which is a good reason to be in that asset class. And apartments are smaller than houses. So you might infer it also might make sense to be in self-storage as well. People keep their stuff. Yep.
Yeah, just as a nice dovetail, because even though you might think it's not going to, in like 3 months of renting, I could go buy this couch brand new again. People don't necessarily think that way. They have attachment to things. And
intelligent people don't think that way. It's kind of amazing. Many of our customers will think they're going to store with us for 3 or 4 months, and 18 months they're still paying rent, and they've already had a rent increase. It kind of becomes out of sight, out of mind. It just hits their credit card every month. They don't want to deal with their stuff. They don't have anywhere to put it. And if they want to find another storage unit that maybe is cheaper on the road. They have to get a friend in a moving truck, go on a Saturday, do a bunch of work. So it's a stickier customer base than you might assume. People stay around a lot longer than they expect to.
Right. Yeah, that makes sense because once, like you say, once it's there, you're never going to move it. You have to go in and throw it away or deal with it in some fashion. And people are, I think, not that excited about doing that kind of work.
Yeah, we have so I'm in my office right now. Obviously, we own an office building in Denver, and we converted the main floor to self-storage. It's pretty small, but it kind of offsets our overhead. And I have a storage unit down there, and I pay our company, kind of paying myself, but I got partners. I pay ourselves $110 a month. And in that storage unit, I keep family heirloom stuff that I don't want in my house, but I don't want to get rid of. And I keep my seasonal gear like skis. I have a ton of skis, mountain bikes, camping gear, and I will indefinitely pay that rent for I don't know how long. It's
Right.
already been a year and a half or two, and I'll keep going. And I probably could have bought some new stuff rather than pay that rent for that long. But
But
that's
you
how it
could,
goes.
but if you don't want those heirlooms in your home, like you say, you might, even if that's all that was in there.
That's right.
Can't,
Yeah,
right. I
they're
can't throw
my
away
old.
grandma's old, whatever, but I certainly don't want it in my house.
Yeah, they come from an old Nebraska farmhouse, and they don't quite match the furniture that my wife has spec'd for our house. So in the storage unit, they stay.
Yeah, they look great there.
They do. They do.
So what kind of ROI can investors expect from a fund like this?
Yeah, we look at our return metrics through kind of two different lenses. We have an IRR target, which is internal rate of return, and that's basically a time-weighted calculation based on a series of cash flows. So IRR accounts for time. And the second metric that we target is a multiple, and a multiple is simply how much equity do you put into the fund, and then how much profit can you expect to realize over the life of the fund is a percentage of your original invested capital. So if somebody puts in 100K and gets back 200, that's a 2 multiple. They put in 100, back 250, it's 2.5. So we target a 14 to 16% IRR over the life of our fund.
Nice.
And that equates to be about a 2 to 2.25 multiple on invested capital. And we try to drive our distributions kind of 50-50 from operational cash flow to some kind of gain on sale when it comes time to monetize the portfolio. But every time we buy a deal, whether we're building something or buying a value add acquisition, our target is always cash flow. We love cash flow. We don't like buying, making better, and selling too often and too quickly. It's taken a long time to learn this, but I think the key to wealth creation in real estate is building an asset base that's sustainable and durable, and holding that for an appropriately longer period of time versus buying, making better, and then selling and doing it over and over again.
Yeah, it's interesting. I think that might be a function. I don't know how old you are, and I'm not going to guess, but I think it's a function of going through multiple market cycles. I actually was invited to speak at a college, and I was on a panel with all people who are younger than me. I think probably I was the only one over 30. And so I've lived through, I'm 59, right? I've lived through multiple market cycles, and I've seen what happens, and I'm listening to all their strategies. And I'm like, all these strategies require that the market is always going forward, that it's always, prices are always going up, right? You get into this situation, and
Yep.
it just can't, it's not sustainable unless you're constantly getting more value. And it just doesn't work that way. And I thought, well, so I said to one of the, I don't want to call them kids, I said to one of the young people, what happens if prices don't appreciate? And even though you've put money into it and fixed it up, what happens if it doesn't appreciate? And they just looked at me like, that's ridiculous. Like, and it, hey, for the last 10, 12 years, right? Prices have been steadily creeping up. So I can understand their mindset, but it's not real life.
Yeah. Values will always go up until they stop. Right?
Exactly.
Yes. Yeah. So to answer your question, and of course I don't know, I just hit 40 back in May. And I started investing in my early 20s, which was right before the financial crisis. So I'm still dumb, but I was much younger and dumber back then. And it hurt. I went through a lot of pain, and I would do it again because I learned so much. But I think about those days constantly, and how we can be well positioned within our portfolio when the downturn comes, which it is starting, by the way. It's not going to start, it's already beginning.
Yeah.
How can we position ourselves to kind of survive that and thrive through it? I think the answer really is cash flow. If your property is producing cash flow and you've got term on your debt, it doesn't matter what it's worth to a degree, because you're getting recurring revenue streams. You don't have to refinance, and you can kind of ride that cycle out.
Exactly. It doesn't matter what it's worth unless you have to sell it, right? So if you put
Yeah.
yourself into a situation where you don't have to sell it, it's okay, right? It's not
Yeah.
costing me anything to hold this money. I'm actually making money. So I'm just going to ride this wave, like you
Yep.
said.
There is a reckoning coming in the real estate space. It's already started. You talk to people who say, "Oh, I've been investing for 10 years. Look at my returns." What I want to say, which I don't, is you couldn't have lost. I mean, it's been such a bull run.
Right.
Let's say an operator is a fix and flipper. They do their first multifamily syndication. They build apartments. They raise some capital. They might have busted through their hard costs, blown their budget. They might have taken a lot longer to build the building they originally thought they would, but they were saved by cap rate compression and rising rents. So when they sold it, it was a home run. It wasn't,
and they thought it was something they did.
Yeah, and truly, like our successes too, they haven't really been because of something we did. It's because we timed the market right. And sometimes some of our home runs, the returns have been something we never could have dreamt of modeling. And there's an execution component to it. You have to go out and execute and manage your property the right way, and construction, all those things. But so much of this game is just kind of luck on timing the market. But if you're not trading in and out of deals, you don't have to time the market, right?
Exactly.
Yeah.
Exactly. So what happens though if somebody gets into a situation where they're in one of your funds and then they say, "Oh gosh, something's happened, a life event, whatever, I need to get my money out." Do they need to wait until you sell that asset?
Yeah, there's a few main disadvantages to investing generally in a private real estate syndication or fund. I think the primary disadvantage is investors generally have a lack of liquidity. So it's not like you put 100 grand in and you buy Amazon stock and you can sell it the next day and get a wire to your Schwab account.
Right.
It's very different. So we have a mechanism in place that allows for, if somebody wants to get out, they can sell their shares to other investors in the fund. Valuing those shares at that given point in time, any given point in time, could be challenging. And even though we have that, no one's asked to do it. And we certainly don't tell people that they should rely on that as a source of liquidity. So for better or for worse, when people partner with us, they're stuck with us for a while. But they're stuck getting cash flow and depreciation and eventually upside. So it's kind of a longer term commitment, and you're strapped in for the long haul. But I think it still works.
So how would this differ from, say, being involved in a REIT?
Yeah, one of the big differences, I could go on and on for REITs about REITs for a while.
Well, I know a lot of REITs are in self-storage.
Yeah, I'll start by saying the REITs are they're big gorillas. They have tons of properties. They have a massive asset base. And we used to use, early in our storage careers, we used to use a number of the REITs to manage our properties. And we were kind of dazzled with their revenue management algorithms, their branding, their marketing. And after the honeymoon was over, we realized over time that our interests were not aligned. Their marketing expense loads are fairly bloated. They're not paying attention to revenue management like an owner does. And there's a lot of ancillary revenue streams in self-storage, specifically tenant insurance. It's kind of like car rental insurance. The margin on that's massive if you ever get car rental insurance. So they try to sell it to you. They keep that revenue stream. And
it's not part of the REIT.
Yeah, and that's a big piece of the REIT's bottom lines is tenant insurance revenue. You can look at their stock reports and see it. But after we kind of realized that we have a misalignment of interest, we formed our own management platform and we started self-managing. And we're not necessarily smarter than the REITs, but we care a lot more and we watch our numbers a lot more carefully. And I think our revenue streams reflect that. But to answer your original question, why go private versus a public REIT? One of the main disadvantages of buying into a REIT is you're not enjoying the tax benefits along the way of the property's asset base. So you're not getting a K1 with depreciation that you could use to offset your other passive gains in a given tax year. But the main advantage of buying into a REIT stock is something we touched on earlier, which is liquidity. right? If you buy public storage stock, you can sell it, on the stock exchange and get your money back right away.
Right.
And generally, the REIT returns have been lighter than the private space as well. But REITs are a good way to participate in the asset class, and it's not a huge commitment. You can get your money back pretty easily when you sell the stock. But REIT stocks this year have gone down in some cases up to 30% since January in the self-storage
Ouch.
space. And our portfolio has not gone down by 30% since January. So there's a lot more ebbs and flows kind of on the valuation. But yeah, it kind of depends on what you're after, advantages and disadvantages to both.
And so what could someone expect if they decided that they wanted to invest with you? How would it work? What's the, I don't know,
Yeah. So
interview
we have a
process, I
pretty,
guess I would say.
yeah, typically most funds and syndications have a couple common elements. And one of those is something called a preferred return, or PREF, if you want to sound cool. A PREF is simply designed to get investors a minimum per annum return before anything else happens. In the case of our funds, it's 8%. After 8% is paid current, every distribution thereafter above 8% goes to return investor capital accounts. So said otherwise, investors get all of the distributions the fund makes until PREF is current and until a return of capital. And then after that, everything is split between 70-30 to 80-20 in their favor, depending on how much they invest. So that's our waterfall. And as far as the process goes, it's pretty simple. We have an online portal people can use to make a capital commitment as well as complete their subscription documents. Once they go through that process, we countersign, we coordinate funding, and once they fund their investment, their preferred return begins to accumulate, and they're buying shares into our fund vehicle. And regardless of when they come in, whether it's today or next year, depending on when we close the fund, they're participating in the entirety of the fund's asset base on all the deals that we've bought since leading up to when they funded, and all the deals we will buy after until the fund closes. So one of the main advantages, whether it's self-storage, multifamily, whatever, of a fund, is generally the geographic and cash flow diversification that a multi-property asset base offers versus investing in one deal. Mm-hmm. And we do syndications and funds, as I mentioned earlier, but inevitably, say it's a 20 property portfolio in a given fund. In a given quarter, maybe 2 or 3 deals are performing behind forecast. Maybe there was a repair and maintenance issue or higher number of move-outs than we expected, but those are balanced out and even shored up by the other, call it 17 deals that are performing on or ahead of forecast. So funds are a little more diverse. It's almost like whatever the asset class is, it's almost a mutual fund of that asset class, if that makes sense.
Yeah, interesting. So do people have to be accredited investors?
Yeah, in the case of our funds, they do. We're a 506C designation, which means that we can generally solicit. So if we wanted to, we probably won't do this. We could put up a billboard next to the highway saying invest with our fund. Yeah. But in exchange for that ability to kind of go out and market and advertise, you can only accept accredited investors, and you also have to verify their accreditation with some kind of third-party validation, either a CPA letter, or there's some websites out there you can go to that let you kind of upload your financials and make sure you're accredited. But yeah, accredited only. And for those of us listening, you don't know what that is. You either have to make $200,000 a year if you're single, or $300,000 a year if you're married, or have $1 million in net worth outside your primary residence. So any one of those thresholds by themselves work for accreditation.
Cool. And what if somebody wanted to?
But not huge.
Oh, sorry.
It's a bit of a barrier, but
yeah, but you don't want people who are like, hanging out and who can't really afford to put that money away for a while. I mean, it's
we don't want somebody with $100,000 to their name giving us 50. That's never
exactly
good, never good balance.
Right.
Too much
They'll
pressure.
be calling you every day. What do you mean somebody moved out of that space? I was over there and I saw 2 moving trucks. What are we going to do?
Yes, this is my last hope. What do you mean it's not going well? Yeah.
Right. Exactly.
Don't want that.
So how about people, I don't know how many people are familiar with the idea that they can use money from their IRA to do this sort of an investment. Do you want to talk about that a little bit?
Yeah, certainly. We have a lot of investors who invest in our syndications and our funds using self-directed IRAs. And there's a number of implications to think about using a self-directed IRA, but we'll keep it high level. One of the disadvantages of investing with an IRA is you're not enjoying the depreciation during the hold period to offset your other passive gain sources on a given tax year. But the advantage of an IRA is when there's a reversion event, your taxable income on those capital gains is either zero or much less. So you're not enjoying the tax benefits along the way, but when there's a liquidity event and some upside, you're saving a lot on taxes on the back end. So
Right.
it just kind of depends on what your strategy is. And I kind of look at IRAs as, to a degree, depending on your age, house money. Like you can't touch it for a while. You can't get to it if you want to. You might as well park it somewhere that's going to grow over time within real estate. So we think that's a good option for folks who have those IRAs kind of sitting around that aren't doing anything.
Well, especially if you think about it, I don't know how many people, I mean, this isn't an IRA conversation, but like if you have a Roth IRA, right, you're just getting such great returns that you don't have to, that you're never, right, going to have to pay taxes on.
Right.
Right?
Exactly.
It's just,
That's the idea.
yeah,
That's the idea. Yep. Yeah,
compared to like,
you are missing depreciation, but a lot of our investors, depending on kind of the avatar of a given investor, let's say you're an attorney making good money, you own a house, you own some stocks. Even if we're giving that investor passive losses, they can't use those passive losses to offset their active income. So even though they're getting a big W-2 and making a lot of money every year, those losses aren't really doing much for them.
right.
So sometimes it doesn't matter that someone's getting losses because they don't have anything else in their portfolio they can use to offset.
Right.
So really just depends on your tax situation and what your investment portfolio looks like.
Yeah. So Jacob, I mean, I think we've kind of got into a little bit of, helping people to understand how this could work and stuff. Are there questions that you wish I would be asking you right now that I'm not asking out of ignorance or just, cluelessness?
No, certainly not out of ignorance or foolishness, of course. I think if someone's out there considering and they've been thinking about pulling the trigger on getting into real estate at some point, I think there's never a good time to invest and there's never a bad time to invest. There's never a perfect deal. And I think the worst thing you can do is sit on the sidelines and just, wait for the perfect opportunity, because frankly, that perfect opportunity will never come.
Right.
And even when there is a perfect opportunity, you won't realize it was perfect.
You didn't know it until it's too late.
Until a year later, right? You're going to say, oh, I should have bought that deal. And who knows, like COVID, right? Should have bought every house we possibly could in, June of 2020, and then blew out of it Q1 of 2022. We'd be heroes. We didn't know.
If we'd only known.
So yeah, you're not creating wealth and you're not learning anything by sitting on the sidelines. So I encourage you to take action for sure. And whether that's buying your own rental property or investing in a fund or syndication, I think putting money to work is important because your greatest asset is time. And if you're not taking advantage of that time to let that money grow, you're losing out. If you do invest in a private syndication or fund, I encourage you to get to know the sponsor really well. Make sure what they're telling you is true, track record, performance history. I think transparency is very critical. If the sponsor won't show you what you want to see when you ask for it, that's probably an early sign. Maybe you shouldn't work with them. And I think another really important component, which is kind of tougher to do to a degree, but understanding whether that sponsor's strategy and their return targets are driven by reasonable and achievable assumptions. So not looking at something where if everything goes perfectly, right, we're going to make a 15% IRR. You want to understand the different levers that can be pulled in a model, just high level assumptions that can be made that can materially change the return target of a given deal. And we see a lot of offerings out there that they'll show a refinance in year 2 returning 50% of investor capital. Then they'll show a really low cap rate exit on year 3, and lo and behold, the returns are awesome. Well, especially in this environment, how can you predict what your cap rate's going to be down the road?
Right.
And then also, how can you predict when you can refinance and how much, right?
Exactly.
I never would have predicted a year ago that interest rates would have doubled. Never would have thought that would happen, but it did. So predictions are generally wrong, mine
Yeah.
included.
I actually heard somebody say the other day something about interest rates have never been that high or something. And I was like, when I bought my house, my first house, interest rates were 13.5%. And it was so good because they had been 18.
I
And
know.
everyone was like, oh, they're down to 13%. Great. And, I hear people now saying, oh, what do you mean they're not 4% anymore? It's not 4%. Get a grip,
We all have such short memories.
Yeah.
This shock over interest rates. I mean, relative to where it was a year ago, it's been a big
Right.
increase. But relative to the history of interest rates, 6 or 7% is still relatively attractive. That's still
Exactly.
relatively cheap money.
Yeah.
It's going to impact deal valuations. It's going to impact cash flows, of course, and affordability on single family homes. But yeah, you're right. It's not 18% like it was back in the day. Um, what they interest rates have certainly been higher than they are, but what might be true, which I'll have to check on, is I'm not sure if interest rates have ever risen as quickly as they have
This
in
was
the last
definitely
couple of
quick.
quarters. I mean, it's been a vertical trajectory, and we're recording this on November 10th, but the inflation numbers came out and they weren't as bad as everybody thought. And the markets react irrationally, but the Dow's up 1,000 points and the 10-year treasuries dropped like 35 basis points, which is a massive drop. I'm sure some other news will come out on Tuesday, and it's going to go the other direction. But yeah, it's been a big run up in the cost of capital, and I think it's going to be a real impact, specifically on the real estate market.
Yeah.
You
But that's
can't.
why, as you're talking about, self-storage, it sounds like it almost could be the opposite, like a very complementary market. Because as there are more, as people are having trouble maybe paying their rent or buying homes on the other side, they're going to need to have self-storage. They're going to need to have more, places to put things while they're temporarily in an apartment waiting for interest rates to go down, for example,
Yep. Yeah.
downsizing, right sizing, moving to different places where they just can't maybe afford to buy what they thought they were going to be able to afford to buy right now.
Yeah, we'll see how the demand kind of sustains as things soften up.
Yeah.
But in an inflationary environment, because our leases are month to month, as painful as inflation is, it actually is a benefit because you can more aggressively raise rates over time.
Yeah.
Because everything else is going up, right? Their gas is going up, their rent, their food. So they're kind of used to bills going up, as painful as it is.
Right.
But there's an inflection point eventually. People just can't afford to pay anymore, right? And I think the country, in a lot of ways, is kind of reaching that. Filling up your gas tank, your utility bill, trying to buy a used car, right? Prices have dropped a little bit in used cars, but those are just through the roof. So I'm hopeful there's going to be a cleansing soon and a moderation to kind of get us back to normal.
Yeah, I know it does seem like people have been kind of beat up lately between, COVID and now gas prices and now inflation and interest rates. And it's like, what next?
Yeah, it's one thing after another. I mean, as terrifying as COVID was, and the impact it had on the economy, I think with a lot of government intervention with shutdowns, I think the situation is perhaps more financially meaningful and terrifying. I think we're going to see a massive drop in real estate values if these interest rates continue.
Yeah.
Because commercial real estate and residential, to a degree, trades on a cap rate basis, which is a multiple of the income stream it produces. And there's an inverse relationship between values and cap rates. The lower the cap rate, the higher the value.
Yeah.
Historically, an infill storage facility that's stabilized or an infill multifamily building that's Class A was trading at a 3 or 4% cap rate. Well, you cannot buy a deal at a stabilized 3 or 4 cap and finance at a 7, right? The
Exactly.
math doesn't work anymore. So
doesn't
one of two
work.
things have to happen. Either interest rates have to drop, which they're not going to anytime soon. They'll normalize eventually, but
Right.
not soon. Or values have to drop. So we're going to see some asset declines, I think, here in the coming quarters. We already are starting to see it, but it's going to become obvious here, I think, very soon. So be careful in the streets.
Yeah, exactly. There's panic in the streets.
That's right. There's not blood in the streets yet, but there might be pretty soon. Yeah.
So Jacob, thank you so much for being with us today and enlightening us about self-storage. I don't think I've talked to anybody about self-storage before, but now that we're talking about it and thinking about it, it's like in many, many ways, it makes sense. It seems like a really good investment And I think I'd rather be in a private sort of situation rather than a REIT. I have some experience with REITs, and I did not love that experience. Like you say, a lot of over promising and under delivering, and
Certainly.
whatever. But
Well,
so how can
as boring as self-storage is, that's not necessarily a bad thing to be, right?
That's it. Exactly. So how can people reach out to you if they want to talk more about possibly getting involved in investing with you?
Yeah, or just talk shop about real estate in general. If you have a
Sure.
deal you want to look at, always happy to talk. They can email me, Jacob at VanWestPartners.com. They can go to our website, VanWestPartners.com, or they can hit me on LinkedIn, Jacob Vanderslice.
Great. Excellent. And I'll put all those links in the show notes for everybody, so you don't have to try to write them down if you're driving. And think now, listeners, think about who who's in a situation where they're just in some kind of dead end investment. They've got money under the mattress and they just don't, they're just not getting the kinds of returns that they could be getting. And maybe put them in touch with Jacob. Maybe send them this link to this episode and, change their potential financial future. And have a wonderful week. Jacob, thanks so much for being with us.
Thank you, Christine. We appreciate it.